The rally in equity markets came to a screeching halt in financial year 2022-23 as investors looked for risk-free bets amid recessionary concerns. The raising of interest rates by most global central banks, including the Reserve Bank of India or RBI, sucked liquidity out and saw downward revision in growth forecasts. Given this, the BSE Sensex is set to end FY23 with a loss of 1.6% and the Nifty 50 with a loss of 2.7%. By comparison, the Sensex had rallied a little over 18% in FY22 and 68% in FY21. Analysts, however, believe the recent correction in stock markets has made valuations attractive.
So my view is that FY24 will be a better year compared to FY23 for the simple fact that valuations and expectations are both quite low as of now compared to what it was when we entered into FY23. With the headline index trading at 18x 1-year forward multiple compared to almost 23x, which was at the beginning of last year, the downside risk looks quite limited unless some new unforeseen event pops up. Talking about the return expectations at the index level, I would say, though I'm not in the game of predicting index levels, but I would take the liberty to forecast what could be the conservative returns from the current levels on the index. Getting a high single digit or the low double digit kind of a returns on the index is quite possible from the current levels, considering that most of the negatives are already priced in. And currently the valuations are also quite supportive. The two main triggers which I see in the market, one is the central bank, the rate hike cycle, which could peak out, or if there's a pause in the central banking rate hike cycle, both in the US and in the Indian markets over the next 6 months, that could be an immediate short-term trigger for the market. The second major trigger for the market could be if the monsoons are not as bad as is being predicted by some of the reports as of now. Any deficit in the rainfall below 90% could become kind of a risk for the whole consumption for that part of the economy. Among the other major risk, I would say the market could remain subdued if there's a significant dip in the economic activity in the developed markets of US and Europe.
Small caps have been hit on the chin so far this year, with the BSE Small Cap Index slipping nearly 7%. Meanwhile, over half of BSE 500 stocks recorded negative returns in FY23. A total of 12 stocks saw their market price tank over 50% so far in FY23. These included 3 Adani Group companies, Adani Transmission, Adani Total Gas and Adani Green Energy. Among sectors, information technology, realty, metals and pharmaceutical indexes have lost over 10% in FY23. Auto, capital goods, fast-moving consumer goods or FMCG and public sector undertakings meanwhile have outperformed. Nitin Raheja of Julius Baer India suggests investors buy and hold from a medium to long-term perspective. Given long-term PE average of last 20 years, there is clearly a 17 to 18% upside in the markets over the next 12 to 15 months. He, however, said that this would depend on earnings growth, the valuations and change in FPI flows. Foreign portfolio investors have pulled out over 39,700 crore rupees from the Indian equity market so far in FY23. Overall, FY24 promises to be a better year if no unforeseen events change the investment environment. Monsoon, inflation, and interest rate trajectory will remain key monitorables. Today, global cues and monthly FNO expiry will sway the markets.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.